Right now, today, there is a number sitting inside your bank account, and if that number is anywhere near $10,000 or above it, I need you to stop what you are doing and watch this entire video. Because in 2026, the IRS has quietly expanded the way it monitors American bank accounts, and seniors are being caught off guard every single day, not because they did anything illegal, not because they hid anything, but because of a rule that has existed for decades, a rule that the banks are not required to explain to you, and that the IRS is certainly not going to announce on the evening news. Here is the truth that nobody is telling you. The moment certain things happen inside your bank account, a report is automatically filed with the federal government, without your knowledge, without your consent, without a phone call, and once that report is filed, your account is under a microscope. Every deposit, every withdrawal, every transfer, all of it scrutinized, going backward and going forward. My name is Marcus Graves, and for years I have been helping American retirees understand the financial rules that the system never bothered to teach them, and I can tell you right now, this is one of the most important videos I have ever made. Stay with me for the next 15 minutes, because I am going to walk you through exactly how this rule works, the 7 things that can trigger an IRS flag on your account, and 3 concrete steps you can take this week to make sure your savings are fully protected. Let us get into it. Before we talk about what triggers a flag, you need to understand the foundation, because once you understand this, everything else is going to make complete sense. There is a federal law called the Bank Secrecy Act. It has been on the books since 1970, and buried inside it is a requirement that affects every single American with a bank account, including you. Here is what the law says. Anytime you deposit cash, withdraw cash, or conduct a cash transaction of $10,000 or more in a single business day, your bank is legally required to file something called a Currency Transaction Report, a CTR. They file it directly with the Financial Crimes Enforcement Network, which reports directly to the IRS and the Department of the Treasury. They do not ask your permission. They do not send you a copy. They do not even have to tell you it was filed. It simply happens. Automatically. Now here is what I want you to hear very clearly. Filing that report does not mean you are in trouble. It does not mean you are being investigated. The vast majority of CTRs are filed on completely innocent transactions every single day. The problem is what happens next, because the IRS does not just look at that single transaction. They look at everything around it, the pattern of your account, the history of your deposits, the timing of your withdrawals. And that is where millions of seniors, people who have done absolutely nothing wrong, end up in a situation they never expected. Here is the one thing I need you to understand before we go further. There is a massive difference between breaking the law and triggering a flag. You can trigger a flag without breaking any law at all, and once that flag is triggered, the burden of explaining yourself falls entirely on you. That is what this video is about. Let us go through every single trigger, one by one. Trigger number 1, and this is the one that I have seen cause the most damage to the most innocent people. It is called structuring. Here is the scenario. You have $15,000 in cash. Maybe it came from selling a car. Maybe it is savings you kept at home. Maybe a family member paid you back for something, or you heard somewhere that $10,000 triggers a bank report. So you decide to be smart about it. You deposit $8,000 on Monday. You deposit $7,000 the following Friday. Problem solved, right? Wrong. Completely wrong. What you just did has a legal name. It is called structuring, and it is a federal crime. A federal crime, even if every single dollar you deposited was completely legitimate, completely earned, completely taxed money. The law does not care why you split the deposit. The law sees one thing, a deliberate attempt to stay under the reporting threshold, and it treats that attempt as a crime in itself. The penalty for structuring can include civil asset forfeiture, meaning the government can seize the entire amount while the case is being investigated, not after a conviction, while it is being investigated. I have personally spoken with seniors who lost access to their savings accounts for months because of this, people who had no idea structuring was even a word. The rule is simple, but it is not obvious. You cannot break a large cash transaction into smaller pieces to avoid the $10,000 report, not across 2 days, not across 2 weeks, not even across 2 different branch locations. The bank's system connects all of it. If you have ever done this, even once, even years ago, make note of it, because it may explain flags that are already sitting on your account right now. Trigger number 2. And this one is the most heartbreaking to talk about because it involves the most genuinely innocent behavior on this entire list. Repeated large cash withdrawals just under $10,000. Let me paint you a picture that I have seen play out more times than I can count. You want to help your grandchild with college expenses, or your daughter needs help with a down payment, or you want to pay a contractor in cash because that is how you have always done things. So you go to your bank, you withdraw $9,000. The following month, you withdraw $8,500. 2 months after that, $8,500 again. Every single transaction is under $10,000. You did not structure anything intentionally. You just needed cash and you withdrew it. But here is what your bank sees. Their compliance software, and every major bank in America runs this software, looks for patterns. And the pattern it just identified on your account looks exactly like someone who knows about the $10,000 threshold and is deliberately staying under it. Your bank files what is called a Suspicious Activity Report, an SAR. Unlike the Currency Transaction Report, you will never be told an SAR was filed. There is no notification. There is no appeal. It simply sits in a federal database, attached to your name, your social security number, and your account, for 5 years. Now I want to be clear. An SAR does not automatically trigger an audit. Most of them are never acted on. But if anything else on your account draws attention, anything at all, that SAR becomes part of a larger picture that investigators will use. The solution is not to stop accessing your own money. It is to document why you are accessing it. I will walk you through exactly how to do that in the protection section coming up. Trigger number 3. Sudden large deposits into an account that has had consistent low activity for years. This one catches seniors completely off guard because it is almost always connected to something wonderful. An inheritance, a home sale, a legal settlement, a large gift from a family member. Your account has had between $2,000 and $5,000 moving through it each month for the past several years. Then one day, $45,000 lands in your account from the sale of your mother's home, or from a life insurance payout, or from selling your own property. That spike is an immediate red flag for the IRS algorithm. Not because the money is illegitimate. It almost certainly is completely legitimate. But the system sees an unexplained deviation from your established financial pattern. And unexplained is the key word. Here is what most people do not know. If you know a large deposit is coming, a home sale, an inheritance, an insurance payout, you should contact your bank before that money arrives. Tell them what it is, where it is coming from. Ask them to note it in your account file. That one phone call, which takes less than 10 minutes, can be the difference between a deposit that processes cleanly and a deposit that triggers a review that freezes your account for weeks while you try to explain yourself. Documentation before the money arrives is always more powerful than explanations after. Trigger number 4. Frequent transfers between accounts at different banks. Moving money between your checking and savings at the same bank. That is normal and the system knows it. But if you are regularly moving money between accounts at 2 or 3 different financial institutions, the IRS pattern recognition sees something called layering. Layering is a technique used in money laundering to make the origin of funds harder to trace. The IRS algorithm does not know you are simply chasing a better interest rate at an online bank. It sees money moving between institutions in a pattern that matches a known financial crime technique. Every time you transfer money between different banks, have a clear reason documented somewhere. Even a simple note on your phone with the date and the reason is better than nothing. Trigger number 5. Receiving payments labeled as gifts just under the reporting threshold. The annual gift tax exclusion in 2026 is $18,000 per person. Gifts below that amount do not need to be reported by the giver. But if you are receiving multiple payments from different people, or even the same person, that come in at $9,000, $9,500, $8,000, the IRS sees a pattern of gifts engineered to stay under both the gift tax threshold and the currency reporting threshold simultaneously. Even completely legitimate family financial help can look suspicious when it follows that pattern. The fix is simple. Have the family member write a short letter each time. Date, amount, reason, relationship. Signed and kept on file. It costs nothing and it protects everyone involved. Trigger number 6. Using cash for unusually large personal purchases. Buying a car with cash. Paying a contractor cash for a large renovation. Purchasing jewelry or collectibles in cash above certain amounts. Many businesses are now required to file their own reports when they receive large cash payments. And when those reports cross-reference with your banking history, the IRS can build a picture of cash flowing out of your account in amounts that do not match your reported income. Again, the fix is documentation, receipt for the car, signed contract for the contractor. Keep paper for everything above $1,000 in cash. Trigger number 7, carrying more than $250,000 in a single bank account. The FDIC insures deposits up to $250,000 per depositor per institution. Any amount above that is uninsured, meaning if that bank fails, that money could be gone. Beyond the safety issue, large account balances draw IRS attention because they represent concentrated wealth that may not have been fully disclosed on tax returns. If you have more than $250,000 sitting in a single account right now, that is something to address immediately. Spread it across multiple FDIC-insured institutions. Protect it from both bank risk and unnecessary scrutiny. Now I want to give you something you can actually use, because knowing the problem is only worth something if you walk away knowing what to do about it. Here are 3 protection steps you can take this week, not next month, this week. Protection step 1. Call your bank and ask about your account history. Ask them directly. Has any report been filed on my account in the last 24 months? You have a right to this information. Your bank's compliance department can tell you if a currency transaction report has been filed. They cannot confirm a suspicious activity report. That is confidential by law. But they can tell you if your account has any flags or holds that you should know about. Most seniors never ask this question. Most banks never volunteer the information. But knowing early, before you receive any IRS correspondence, gives you time to consult with a tax professional and address anything proactively. That is always better than responding in a panic after a letter arrives. Protection step 2. Spread your savings across multiple FDIC-insured institutions. No more than $250,000 at any single bank. This is not about hiding anything. This is standard, responsible financial practice that every certified financial planner recommends. It protects you if a bank fails, and it reduces the single account scrutiny we talked about in trigger number 7. A straightforward way to do this is to open a high-yield savings account at a second FDIC-insured institution and move a portion of your savings there. The interest rates at online banks are often significantly higher than traditional banks right now anyway. You protect your money and you earn more on it at the same time. Protection step 3. Build a simple transaction record and keep it updated. You do not need an accountant for this. You do not need special software, a plain notebook, a folder on your computer, even a notes app on your phone. Every time you make a large cash transaction, anything above $1,000, write down 4 things: the date, the amount, where the money went or came from, and why. That is it. 4 pieces of information. And that simple habit, which takes less than 2 minutes, can be the difference between a routine year and a stressful, expensive IRS review. The IRS does not go after people with clean, documented records. They go after the unexplained gaps. Give them nothing to question and they will move on to someone else. Now, I promised you a bonus at the end of this video, and I want to be upfront about who this is for. The 7 triggers we just covered apply to every senior with a bank account, regardless of income or savings level. But this bonus is specifically for the retiree who has built up solid assets, a traditional IRA, investment accounts, a paid-off home with equity. If that is not where you are right now, everything you need is already in the first 3 protection steps. But if you have built something up over your lifetime, this one strategy can quietly save you thousands of dollars every single year, and almost nobody in your position is using it. It is called a Qualified Charitable Distribution, a QCD. Here is how it works. If you are 70.5 years old or older and you have money in a traditional IRA, you are allowed to transfer up to $18,000 per year directly from that IRA to a qualifying charity, your church, a local food bank, a hospital foundation, any IRS-recognized nonprofit. And here is the part that makes this so powerful, that money never shows up in your taxable income, not as a withdrawal, not as a deduction. It simply does not exist as income for tax purposes. That is not the same as a deduction. A deduction reduces your income after it is counted. A QCD means the income is never counted at all. And because your total reported income is lower, everything calculated from that income is also lower. The portion of your Social Security that is taxable, lower. Your Medicare Part B and Part D surcharges, lower. Your overall federal tax bill, lower. And once you reach the age where you are required to take required minimum distributions from your IRA, a qualified charitable distribution counts toward that requirement. So instead of being forced to pull money out, pay full income tax on it, and then donate what is left, you send it straight from the IRA to your cause, satisfy your required withdrawal for the year, and pay zero tax on any of it. If you give to any cause at all and you have a traditional IRA, this is one of the most powerful tools available to you right now. And it is completely 100% legal. It has been in the tax code since 2006, so let me leave you with the one idea that ties everything we covered today together. The Bank Secrecy Act, the $10,000 rule, the 7 triggers, the structuring trap, the suspicious activity reports. None of these rules were designed to hurt you, but none of them were designed to protect you either. The system does not send you a warning letter before your account gets flagged. The bank does not sit you down and explain what a suspicious activity report is before they file one on your account. That information and that protection has to come from somewhere else. It has to come from you choosing to learn it, which is exactly what you did today. Before you go, do one thing for me. Send this video to one person over 60 in your life, a parent, a sibling, a neighbor, a friend from church. The odds are very good that they have more than $10,000 in their bank account right now and have absolutely no idea this rule exists. One share from you could protect their entire life savings. I will see you in the next one.